Joining me here at CBOE is Mr. Noel Smith of Convex Asset Management, Vegas-based here in Chicago. We just did an interview here where CBOE is going to come out about variance futures. Noel, you are a vol expert, and this is also a home to you as well. We talked about this a little bit when you came on my last podcast at my show, or when we were doing hits, which was about what you do at Convex. But I mean, this is where you started as a prop trader. Maybe not this floor exactly, but this is your kind of home court.
Yeah, so I was a market maker for a long time, and it's this is my first day on this new CBOE floor, and it's cool. It's like familiar and home, but not anymore.
Right? What's the biggest thing that stands out as different to you?
It's quiet,
Right.
And there's a lot.
We're also range bound right now.
Yes, but so the old floor was 4,000 people, 5,000 people. Yeah. I don't know exactly, and this is 300, 400, 500 something. Yeah. So it's a lot smaller and it's a lot less rowdy.
Right. There's a lot of I think wrangling of the machines happening too, but also making sure that there's a shorter line of communication between people, finding whatever marginal edge it is. If there's somebody that can be paired feet away from someone to get that quick hand signal, it's amazing to me that no matter how much markets have developed, there still is some use for a human.
Oh yeah.
And this is what you do too, because you've got multiple strategies that you put together into an offering for investors that is ultimately about finding edge in markets.
Absolutely.
Tell me about what you're doing right now.
So the point of our hedge fund is really just to take the ideas from this city and take prop strategies that people know and assemble them into an investable product for our investors. So we're trying to take unique ideas and the things that all of the firms that most investors have heard of but don't ever get access to, and put them into a single bucket and say, okay, yeah, this is alpha that we can use and make money for our investors. And we use volatility as a large component of our alpha.
You like volatility as an asset class, but now there's also another extension of this, which is variance as an asset class. I think this is really interesting. There are variance futures now, which you can trade. Tell me about how you're using those and what value they provide.
So variance and volatility are very linked. They're basically just solving for a different variable in an algebra equation. And when you're trading something like VIX or SPX options, you're looking at implied volatilities at some point in the future. One of the reasons to trade volatility as opposed to stocks, or say you have just the stock price, right? SPY. And it goes up, you make a buck, it goes down, you lose a buck. But in volatility terms, you're predicting the future. It's a future prediction of what things are going to be as opposed to what is right now. And variance is different because instead of having a future prediction, it is saying what is today, or what is today as a function of going back in time. So the variance futures product is something that CBOE developed, and I think it's a unique new thing to add to the toolbox to get accuracy in your volatility predictions.
Now, is it like an additional part of the spectrum of volatility, or do you view it as like another derivative of volatility? What's the input? What's the output? Like when we think about, like people have quick ways to think about vol, where okay, a 16 VIX means a certain move in S&Ps. What's kind of the back of hand math for us to understand how variance correlates to volatility?
Sure. So if you just Google the formula for volatility versus variance, you'll see that variance is just volatility squared. Okay. So if you take a volatility, call it 20. Let's just make quick and easy math. 20 and you square it, you have 400. Okay. And if you take 30 and you square it, you have 900. Right, exactly. So if you look at a variance future, you'll see a price of, say, 400. Like I bought variance futures a couple days ago, and they were 330. So that implies some volatility less than 20. Okay, probably something more like 15. So all we're really doing is we're solving in a different dimension. But the difference is that if you are trading VIX and you need to say to hedge, what happens is the marketplace is still predicting forward VIX as being something that might mean revert. Right, and they might smash it. So you have a bunch of VIX on, you make money because volatility goes up, the stock market goes down. But if you don't hedge it right away and accurately, then you kind of miss the event. Versus in variance, what
less
will happen,
timing element to it for variance?
less of a timing element.
Right.
Yes. So it becomes a little cleaner hedge, and it's also more convex because it is a squared function. It is not a linear function. It is more convex to it.
Does that mean it can go from cheap to valuable pretty quickly?
It can go from. It's funny because it's not linear. So in other words, if you go from vol 10 to vol 11, it's not that big of a move. But if you go from vol 50 to 51, even though it's still those are both one,
right?
It's a much larger percent.
Yeah.
Exactly.
Yeah.
So you have to kind of know the product and learn it a little bit, but it can add a totally unique dimension to it. And also in one of our trades, which is a dispersion trade, you can get away from strike specificity. So if you are trading options at the money options in SPX, you can get away from strike, and then your options become less useful, right? If you're trading 50 delta options, well, it's 50 delta at 6,000. It's not going to be 50 delta at 5,000 or 4,000 or 10,000. In variance space, it doesn't matter. That dimension has been totally taken out of the equation. So what you can do is you can trade short vol and collect realized variance no matter where the actual number of the SPX is.
Okay, I'm doing a little math here to kind of put into some numbers what you just described there about the variance of or the convexity of variance, which is I think is a pretty interesting way to do it, because if you said 51, the move from 50 to 51, basically, right?
It sounds like one, but it's not.
Right. But the difference is that it becomes a pretty big spread because you've got 50 times 50 versus 51 times 51.
Right.
So that becomes a pretty quick move. That one, when you're already at 50,
exactly
multiplies out a lot. So can it be used as a higher probability way to hedge then that is less timing sensitive?
No.
Or is it more about the bigger payout if you do get the timing right?
It's a bigger payout if you get the timing right and you're long it.
Okay.
Obviously, if you short it, it cuts both ways.
Right. Other way.
So I don't think there's any inherent edge in trading any product over another product. It's just a thing, right? It's a widget you put into the toolbox. But what can be done is you can trade it in a way that you add what actually has happened as opposed to the market's future prediction of what will happen. That's the biggest difference.
Nice. All right. Well, you just did another explainer for CBOE that's going to be coming out for them soon. Love that you gave us one here as well. And a nice rundown through the numbers. Appreciate it, Noel. Good stuff.
Thanks for having me.
Great addition to the conversation here.
Cool.
As always, Noel Smith, Convex Asset Management. I'll be seeing you in Vegas.
I think so.
Look for Noel when we're at Hood Summit. Appreciate it. Great stuff.